Okay, welcome everyone. We'll start our session. Today lesson will go through LO3. As you know me, my name Anjum Sathar and it's my email anjum@ukversity.co.uk. If you have any question, drop me email. Today lesson will be focus on be able to evaluate the budgetary process and we'll discuss about budget. Budget is a financial plan, is just like a set nav where we are, where we want to. And that will be in our discussion. We have three command verb really, those assessment criteria, evaluate, develop, and recommend. That will goes to budget, types of flexible, fixed, zero-based budget, which is we'll discuss, and budget is start from always sale forecast. When you do forecast about sales, you always will make the budget from it. If the sale forecast go up and down, and we need to be adjust all our other budget like sale budget, a sale forecast based on then production budget and material budget, labor budget, manufacturing budget, all need to be adjusted accordingly based on the demand. So always good to be reflect what is the budget, what is the budgetary control. And 3.1 is evaluate the budget targets for an organization. A plan is expressed in money. It's prepared and approved prior to the budget period. So every country, every organization, they make the budget, and budget is quite crucial and is provide the set nav for the company. Zero based is means start from the zeros. As a new business, you don't have the previous year estimates. Every budget need to be linked with the organization objective and result, what it really you want to achieve within the budget. Budgetary control is the device that the company use all these purposes. We need to be put the control mean the corrective actions. Okay, budget, when we prepare the sale forecast is first, then production budget, material usage budget, material purchase budget, and based on this, we can look around production, sales, closing inventories, and minus opening, and then we can make it budget accordingly. And that's the key really we need to be looking at. Okay, so when we look the budget, sale budget, production budget, and all other budget, those are called spread is based on the sale, and those are speed rate, it's like a supervisory, and we need to be look around subordinates, of that sale forecast. Depends all the budget based on the sale forecast. Okay, so when we make the budget, always keep in mind the budget, the waste, reject, and efficiency. So like, if you want to make 100 units, maybe 10% your waste, 10%. So you have to make it 110, not 100, 10% more. You have to adjust the waste, the reject, yes, finished goods. You have to be look around the wastage in terms of the raw material. You need to be look around in terms of inefficiencies, in terms of the labor. You have to adjust in the budget, because otherwise if you're closing inventory, you can't meet the demand of the clients. And so we need to be make sure, so we look accordingly. Okay. Waste, so this is one of example which we can look around. So we can look around, suppose 2% of all the units produced found is the faulty, so we need to be finished goods 2940 are required. So we need to be, what we do with times by 100 divided by 98. So we have to adjust it to make it 100%. So because that was 98%, 2% waste, we need to be adjusted. So there will be a scrap of 60 and the scrap value, which we can make it and we can sell it at different price as well, which we can look around and we can adjust it. If the material is 10% waste, so if the output is 1000 units to produce J product and other project, so what we do times by 100 divided by 90, so we can say how much material is supposed to be required is 4.5 kg required to use. So we need to be actually required material is a 5000 kg instead of 4,500 kg. That's we need to be always keep in mind budget. If the labor is required 9,000 hours, so if the 10% time is 90% to work and 10% waste, so 9,000 times 100 divided by 90, so we require 10,000 hours. Okay, any question, Asif? Okay, if any question, please you can ask. So incorporating waste into the budget, you may have to drop the production budget, yes, which obviously has includes the cost of the material used in production. We know the material purchase and material used in the production, plus closing inventory minus opening material used in the production, material purchase, and that's all we need to be. So production budget, sales, closing inventory minus opening always, because we're looking what is supposed to be produced and the change in inventory, reject faulty production and how many units we're supposed to produce so we can carry on using. Overhead mean the indirect expenses. We need to keep in mind how much will be. We can make the budget, we can absorb them based on different absorption method, like we discussed in lesson 1, absorption costing. Budget operating statement we can prepare, like the sales revenue, cost of sales, how much we have, opening inventory. So when we say budget, inventory can be 3 types. It's a raw material, finished goods, and work in progress. So all we need to be keep in mind, less the cost, and we'll get the gross profit, then you have overall overheads. Okay. Capital budget, these budget for expenditures on the non-current assets such as the cost down features in the budget. And integrity of the budget management must have a confidence in the budget. We need to be and use monitor the performance. So budget also help find the variance. So this is one of, we can look around, we prepared it. This is the cash budget we can look around. We have a sales, we have purchase, we have wages, we have salaries, and we need to make. So 50% that is paid in the month, after first month. So we can look around the cash positioning based on the criteria, whatever we set as a standard. 50% purchases we buy from the one supplier and 10% will get the discount, and new equipment will cost us. Based on this, and then we can prepare our template. We can look around the purchases we have here. You will see there in July we have. Hi, you okay? Okay, so that's you need to be make sure. So when you do your assessment, so we need to be look around the budget. So if it's 25,000, so you have to make sure if it's we are buying and 10% will get the discount, 50% is 12.5, so 90% will pay of 12.5. So that's we need to, if it's exactly the same sales, we need to look around is a 52,000. So 50% of that will be 26,000. So we can look around in July and August and so on. That's we need to be. We need to, when you do your assessment, and we can add some example these. So please just make sure we can embed it. So some these will be available are VLE, which so make sure you can follow those some examples in assignment as per the scenario is given. So make sure. Okay, so then all these, whatever we done there, all the final figures, you will see last 3 months, really we're making the budget. So the figures final goes in the main template. So we have October, November, December, and we have receipts, so total, and then we minus purchases, wages, salaries, and it's all, and then we can say what is closing we have. That's all we need to be, make sure we'll adjust it. Okay, so that's we need to be carry on doing. Okay, any question? Okay, then so that's as if we have, so we can make the cash budget. This is one of example of cash budget. Then we have 3.2, develop the master budget. Master budget is mean overall budget. All other budget can be summarized into like overall country budget. can be master budget, then the province budget and various other budgets, we can prepare it. The budget will help, so limiting factors we need to be look around in budget. Budget mean the constraint factor can be labor, hour, material, and these things are money. So we need to be embed it accordingly in our, and those, we need to be, when you do make the budget, always you need to be make sure you negotiate with the budget superiors, coordinate with the budget, and final acceptance of the budget. Involve all the stakeholders, make the budget committee, and they approve. Then all the budget, master budget is to in profit and loss and the financial position, all being summarized as part of example of master budget. Okay, rolling budget, the budget which carry on rollover, it has own advantages. It's reduce uncertainties. It can be up to date, and it can be realistic. Budget is a better motivator, but its disadvantage, they include more time, efforts, and money, because you're rolling, but with the limitations or other fluctuation you need to be included, which we need to look around. And why budget is rollover is affected, so affected new competitors cannot be quantified when the budget is set. So inflation is very, very high and expected to be raised and falls at the moment, like which is inflation is more than 10% in some countries, 20 or 30%, even in the UK is 10% or more. So we need to be look around in the rolling budget if we'll carry on rollover, but we need to be embed all the fluctuation. Okay, so method of incremental budget. The incremental budget, the budget you carry on increasing every year, keeping in view of the various factors, like the national minimum wage in the UK used to be £9.50, and ours, which is went up to £10.42. So now we can increment your budget should reflect it. Zero-based budget is budget from start with the zeros, and we'll carry on, and we carry on making the budget. Every time we have to, it's some advantages, because it's good to be estimate everything new, but it's very time consuming, it's costly process, and it's waste the time as well, and it cost us more. So every budgeting technique, whatever we do, we need to be look around the pros and cons, and then you have to accept it, the budget according to. So zero-based budget, identify, remove inefficiencies, obsolete operations. Yes, forces implies to avoid, wasteful expenses, encourage innovations. Yes, lead to be more efficient, but disadvantage involve time and effort, and ranking can be proved problematic, as we mentioned earlier. Sport, expenses, service industries, application, and non-profit organization, discretionary costs can be prioritized based on budget. It can be, we can priorities, but the zero based budget, but does not start from the zero base. Okay, so we can look around activity-based budget, as the word indicate. If you have more activity, your budget need to be more allocated. If you're more patient in hospital, you need more budget for it. Every patient will register, like example. So as the activities increase, budget need to be increased. So budget need to be, if you're making 1,000 unit, 2,000 unit, 3,000 unit, the fixed cost will stay there, but the variable cost can be varied. So we need to be, it's attempt to provide the meaningful product cost is recognized, the many overhead costs arise. It can be diversity, complexity of operation, facilitate. It's help you to facilitate, goods understand of what the drive overhead cost. So when disadvantage, time involved in identifying activities and drivers may be significant. The ability to be single cost driver, and always can be a problem to draw the driver. Motivation, it help, the advantage, the budget will be consistent with the strategic plan, resources that we need to be our money and our views. Disadvantage, lower level of managers may become, demotivated and working. So that's the top down approach, top level, and then coming, that's maybe a couple of you watch, the undercover boss, the boss going, and the actually the CEO of the company changing their outlook, and then, they observing, because it's a sitting from an office to make a budget is easy, but you have to understand that the ground reality, that's, it can demotivate your employees if you don't have a detailed knowledge. It's initiate, the lower level of management may be stiffed. Okay, so bottom up is mean, you listen from the low level employees, operational level. Yes, at ground level, that's we need to be detailed knowledge about motivation managers to achieve, yes, the budget, which is been set up, increase and commitment. But it can dissatisfaction from the negotiation with the budget committee. Managers maybe attempts to be introduced the budgetary slack, the limiter compared to the budget outcome, and more time and more personnel and the lack of coordination can be. Okay, then we have 3.3, critically evaluate the budget and budgetary control. Budgetary control is used to be comprehensive system to budgeting management and increase. What is the management? Is mean creating an environment to achieve the pre-selected objective. The system we need to draw, yes, which we need to be look around the budget center like HR's budget, production budget, these are. And we can look around and all the budget need to be allocated and performance, and budget is it's also is known as the responsibility accounting. So if you've been given responsibility, you have to achieve the targets. So like here, classification of budget, we can look around long-term, short-term, current budget, rolling budget. A function, yes, sale budget, these are called functional areas, and according to the flexibility. And then we say flex budget, fixed budget, the budget stay the same like a fixed cost, it won't change for the certain period. Flex budget, it need to be, if you produce more, we can standardize one unit cost, then 10,000, 20,000, whatever we do, that is called flexible budget. The budget will change, yes, it can be drawn effect of the actual volume. So please, that's also budget and minus actual, we find the variance, and variance is also very important in management accounting and financial management to understand the concept of. So cost behavior, fixed cost which stay the same, variable cost which change with the level of output, and semi-variable is fixed and variable together. Like in lesson 1, we discuss about semi-variable. The telephone line rental is a fixed, call charges can be variable. Flexing cost and revenue is increase or decrease in line with the sale volume. Fixed cost remain the same, and variable cost increase or decrease in the output. Yes, that's we need to be semi-variable cost need to be split into fixed and variable. We can use the high-low method which we discussed. Okay, so we can look around flexing basis. We need to be make sure, like if you're producing 24,000 unit, semi fixed cost is this, and if you're producing 20, so we have 24 and 20,000, there is a difference of units 4,000, and the cost difference is 4,000 as well, so there is a £1. So we can look around this, the cost difference, so there is a £1 that will be 4,000 the unit and cost difference, and then you do 1 times how many units. If you're producing 24,000 will be your fixed, and rest will be your 24,000 will be, if you're producing in a production level, 24,000 times 1, it will be 24,000. Fixed cost 7,000, that will be your fixed cost, because the total was 31. So variable 24 plus fixed 7, so that make you 31. So fixed means stay at the both levels will be the same. So if you do 20,000 times 1, that 20,000, 20,000 minus your 27 minus 20, that will be 7, also fixed. Okay, that's, we're looking here. If you're 90, 100 and 100, so we can look around what was the actual. We can look around and flex it according to the budget. So that's the night. So we can do the standard costing. So that was the budgeted 100%. So we can say this was 100 on the 50,000. So we can find 1 unit selling price times by how many units you have actually done. So we can compare it and we can find the variance, and it's 90%. So we can calculate 90%, 100%. These are all budgeted, and this is actual. We can compare according to. So you will see here the revenue between budgeted and actual. So that's the budgeted price or budgeted cost per unit, which we divide on the 50,000 and times by actually the given and take the difference. So that will be, so that flex budget according to 37,500 units, and then we take the difference, we have a variance. It's favorable and adverse. So we have admin and overheads is favorable, but all other variance is adverse. So overall, if you take the difference between the profit of flex and profit of actual, that will be 103,500 is adverse. So we are losing money here. So we need to be find the causes of the variance. It can be material price went up, labor spent more over than budgeted, and these are the reason late overall drop the profit. So all the working been given, like, which we said earlier. So you 100,000 divided by 50,000, you found 1 unit selling price, you found exactly 1 unit material cost and labors, and you timed by 37. So that's our flex budget figures, and then actually we minus it. Any question, Asif? We all okay? Okay, and then I included, please to read in your own time is before, next lesson. If you just, copy those link, it's a case study, how the plan budget by Davis Group and Zurich Insurance Company here in the UK. They have operation in many words, and I included the budget and the budgetary control video to watch before, and then is a based on your knowledge you tested, please, in the quiz. If you went wrong at the end, will say review, it will show you. Okay, that's all, the reference there. Okay, that's we need to. Any question, Asif? Hello? That's all, we'll keep up to here. If you have any question, please drop me email and I'll get back to you as soon as possible. And today lesson, we went through the budget, and we said budget is based on always sale forecast. So first, then you can make all other budget. We discuss about the budget minus actually the variance, and variance can be. So we can look around the causes of variance. Budget is a provide the set map, is the roadmap, and help to control our resources effectively. Thanks for listening and attending, and I hope so speak you during our next session. Thank you. Bye bye.